Question: A, B and C are partners sharing profits in the ratio of 3:1:1. On 31st March 2010, they decided to dissolve the firm. On that date, their balance sheet was as under: balance sheet liabilities, creditor 6,000, loan 1,500, capitals: A 27,500, B 10,000, C 7,000. Assets: cash 3,200, debtors 24,200 minus 1,200 equal 23,000, stock in trade 7,800, furniture 1,000, sundry assets 17,000. It is agreed that A is to take over furniture for rupees 800 and debtors amounting to rupees 20,000 for rupees 17,200. The creditors of rupees 6,000 to be paid by him at this figure. B is to take over all the stock in trade for rupees 7,000 and some of the sundry assets for rupees 7,200, being 10% less than book value. C is to take over the remaining sundry assets at 90% of the book value less 100 as discount and assume the responsibility for the discharge of loan together with accrued interest of rupees 30, which has not been recorded in the books. The expenses of dissolution were rupees 270. The remaining debtors were sold to a debt collecting agency for 50% of the book value. Prepare necessary accounts to close the books of the firm. Assets having realizable value: debtors, stock in trade, furniture, sundry assets. External liabilities are creditors and loan. Transfer creditors and loan to the credit side of realization account. Capitals to the credit side of partners capital account as balance brought down. Cash to the debit side of cash account as balance brought down. Provision for doubtful debts 1,200. Transfer that provision to the credit side of realization account. Debtors 24,200 to the debit side of realization account and provision for doubtful debts 1,200 to the credit side of realization account. Stock in trade, furniture and sundry debtors all are transferred to realization account debit side. Adjustment number 1. A is to take over furniture for rupees 800 and debtors amounting to rupees 20,000 for rupees 17,200. So total amount payable by A 800 plus 17,200. Book value of debtors taken over by A is rupees 20,000, but he agreed to pay only rupees 17,200 for that debtors. Furniture rupees 800 and 17,200 for debtors. Total amount payable by B 18,000, which is recorded as A's capital on credit side of the realization account. By A's capital 800 plus 17,200 18,000. Adjustment number 1. Creditors of rupees 6,000 to be paid by him at this figure. A agreed to pay creditors of rupees 6,000. For the payment of creditors by partners, external liabilities by partners, which is debited to realization account in partner's name. Realization account, debit side, fourth item to A's capital, rupees 6,000. That is for the payment of creditors by A. Next, adjustment number 2. B is to take over all the stock in trade for rupees 7,000 and some of the sundry assets for rupees 7,200. B is to take over stock in trade for rupees 7,000 and sundry assets for rupees 7,200. So amount payable by B 7,000 plus 7,200. Stock 7,000 and sundry assets 7,200. Total amount payable by B 14,200, which is credited to realization account by B's capital account. Stock in trade 7,000, sundry assets for 7,200, total 14,200. Third adjustment, C is to take over the remaining sundry assets at rupees 90% of the book value, less 100 as discount. For that, we have to calculate remaining sundry assets. Working note number 2, sundry assets. Total sundry assets were rupees 17,000. Asset taken over by B. Amount paid by B is rupees 7,200. That is 10% less than the book value. In other words, 90% of the book value. 10% less than the book value means amount paid by B is 90% of book value. 90% of book value of sundry assets is 7,200. So the book value of sundry assets taken over by B is 7,200 into 100 by 90 equal 8,000. Total sundry assets 17,000. Book value of sundry assets taken over by B 8,000. Remaining sundry assets 9,000. C agreed to take over remaining sundry assets at the rate at 90% of the book value, less 100 rupees discount. 90% of the book value of remaining assets. Remaining assets, book value of remaining assets 9,000. 90% of 9,000, 8,100 less 100 rupees discount, rupees 8,000. So amount payable by C is rupees 8,000, which is credited to a realization account by C's capital 8,000. Next, C assume the responsibility for the discharge of the loan together with accrued interest of rupees 30, which has not been recorded in the books. Amount paid by C for the repayment of loan. Loan amount 1,500. Interest, accrued interest on loan 30. So total amount paid by C 1,530. External liability paid by partner, which is debited to realization account with partner's name. To C's capital account 1,530. Last adjustment, expenses of dissolution were 270. It is assumed that dissolution expenses were borne by the firm and paid by the firm. So amount is debited with a realization account to cash account 270. Then remaining debtors were sold to a debt collecting agency for 50% of the book value. Calculation of remaining debtors. Total debtors 24,200, out of which debtors taken over by A 20,000. Remaining debtors 24,200 minus 20,000 equal 4,200. Amount realized from remaining debtors 50% of the book value. Last adjustment, remaining debtors were sold to a debt collecting agency for 50% of book value. 50% of book value is 2,100, that is 4,200 into 50 by 100, 2,100. Next, balancing. Realization account, loss 6,800, which is distributed among the partners in their profit sharing ratio. A's share 4,080, B's share 1,360, C's share 1,360. Next, partners capital account. Partners capital account credit side. First item, balance brought down, that is the capital balance as per balance sheet. A 27,500, B 10,000, C 7,000. Next, realization account, A 6,000, that is the payment of creditors by A, and C 1,530, payment of loan by C. Next, debit side, to realization account 18,000, 14,200 and 8,000. 18,000 is the amount payable by A for furniture and debtors, 18,000. Then 14,200 is debited with B's capital account, that is The amount payable by B for stock in trade and sundry assets 14,200 and C 8,000. That is the remaining sundry assets taken over by C. Then to realization account 4,080, 1,360, 1,360. That is the realization loss transferred from realization account. Next, balancing. Capital account debit side, A's column 11,420 to cash account. Other two partners have balance on their credit side 5,560 and 830. These two balances are transferred to cash or bank account. Bank account, first item to balance brought down 3,200. Then 2,100, that is the amount transferred from realization account for the realization of debtors 2,100. Then 5,560 and 830 capital balance transferred from partners capital account. Bank account credit side realization account 270, that is for the payment of realization expense. Then by A's capital 11,420 capital balance transferred from A's capital account. Bank account or cash account total 11,690.